before I come, just a couple of little rules for the game. We won't be able to hear you with questions for this, so please put it in your chat, and then we will repeat it back, and we will take care of it from there. We have a nice room full of people as well who are enjoying cookies and lots of camaraderie for Christmas time. And we're trying to get through this season, right? So that in 2023, we can survive and thrive. And that's our goal for the whole entire year. That's our game plan, survive and thrive. So we've asked our experts, because we love Andrea and Noack Company. They're going to talk to us about Hurricane Ian, how we can navigate some of this so we can get more listings, get the listings to closing, which is really important. Explain a lot of this stuff to your buyers so that they feel confident and purchase and keep our real estate game going in Florida. So without further ado,
thank you. And she said, my name is Andrea Dillon. I think everybody on there was only one name I don't know if they recognize, knows who I am. Carol Carly is joining me today. I'm actually going to let her do a quick intro because she has a very specialty area that I think she should just do a quick, here's what I do.
Good morning, Carol McCarley. I work with Andrea over at Noack Company, and I handle a lot of real estate transactions with taxes and also the FERC department. When you deal with a non-resident alien who owns a piece of property, they're selling it, you have any FERC issues, I can help you with that, get you closing, get you withholding certificates if that's something that they want, or if they need an ITIN, I can help with that as well.
Thank you.
are you part of Noack Company?
I am.
She has been, I think, longer than me, but
About probably the same time, about 14 years ago.
yeah.
So we'll ask a quick question. If they need a TIN number, when should they contact you?
ASAP. As soon as you know what they have, maybe they have an accent, or maybe they have an address that isn't here in Florida. You probably, if it's out of state or out of the country, you definitely need to get me right away. Even if they're buying, and they plan on renting it, then you can have an accent.
I'll have to have my tax file. Okay, hang on to the mic and then you can be passed around as people help.
Sounds good. And I forgot to do my who I am page, but that's who we are. We have offices in Fort Myers, Naples, and Sanibel, and our Sanibel office is all right. We fully expected that it would swept out to sea, but I haven't been there yet. But we have tenants in place there that have said that all that happened was a window got busted, which is boarded up. So we were very fortunate. So we still have all three offices, although Fort Myers is our hub, which is pretty close to you guys. And since I last spoke, my husband, who's here as well, John, my husband and I bought the company. So we are very excited for you. I am recovering, but I promise it's just cold, but my voice is a little hoarse. So I have my water. So what I want to talk about today is Hurricane Ian, but more so about the tax side of things, whether it's for you guys personally, because everybody has had some kind of damage, or whether it's for clients of yours that are asking you questions and things like that, because there's a lot of stuff floating around and not a lot of people know the details about it. And you should. So, my clicker is not here today, so you have to bear with me. So September 28th, 2022. Obviously, these are our pieces. Fort Myers. I think everybody was just completely floored by the devastation that happened. I know my mom lives out on Mount Shea. So my husband went out with her like right after the storm, jumped in our little boat and jetted over there. And it was just, I just went over for the first time this past weekend. So I can't even imagine what they saw when they went over literally the day, Thursday after the storm came. So I don't think anybody was prepared for what we went through. The first and foremost is the deadline was extended. So I know that's really important for our realtors because a lot of our realtors wait until October 15th to file their taxes. So that deadline, the October 15th deadline was pushed. They did that pretty quickly after the storm. I think most people do know that was pushed to February 15th. What was not extended, the September 15th deadline. So people, because September 15th is before the hurricane. So that one did not get pushed there. We had a whole flurry of people who had missed that deadline. Each of them noticed that called us and said, oh, great, do I have more time on that one? Nope, that deadline did not get moved. That was pre-hurricane. So that one, if you haven't filed, those penalties are still kicking. And as a reminder, penalties for those returns that are due September 15th, that means it's an S corp or a partnership, and it's $210 per month, and it goes until you file. So you want to get that one filed. It's a flat fee. It is a nasty penalty. Penalties, so penalties on paying your taxes on time, that was not extended. Because even if you file on October 15th, you have that penalty because you are, what you're supposed to do, the good little taxpayers that we all are, is if we file an extension on April 15th, we're supposed to guess what we owe and pay all of the tax and just get it right. But if you knew what you owed or if you could pay it all, you would have filed on April 15th. So typically people extend because they either need more time to come up with the money, or they need more time to come up with the info and they don't know what to write a check for. So because that is actually due April 15th, that was not extended. So that penalty, it's usually a small penalty, but the penalty on not paying is still going. Quarterly payroll was extended, but not, I'm not going to go too deep on this, but not quarter three. So any deadlines that are after it. So the quarter three deadline would have been pre-hurricane. So anything, the monthly payroll that's being remitted, that is extended. And the quarter four estimated tax. So if you are one of the people who really religiously pays your quarterly taxes by those deadlines, quarter four would be quarter three would have been due September 15th, pre-hurricane. So quarter four, which is January 15th, they are giving you that extra month to get that one. Okay, so while the deadline was extended, there are some important things to know about that. First and foremost, if you are doing any kind of SBA loans, which we are not talking about today, but there are business SBA loans and there are personal SBA loans. So we have a lot of people who had physical damage to their houses and they either had really high deductibles or their insurance isn't covering it. Maybe their pool cage went down and they didn't have the screen enclosure covered and it's $30,000 to rebuild it. So they're going to the SBA for these loans because they're really, really favorable loans. They're like 30-year repayment. So really low cash flow for you. You will not get an SBA loan if your taxes aren't filed. So we've already started to see those kick back. That was a fun surprise because our deadline was extended. So you are still in compliance if you have not filed yet, but the SBA does not care. So if you are trying to get a business or a personal SBA loan, they will deny it if your taxes are not filed. So you can't wait. Then the IRS, which another fun surprise that pops up. Every year, the IRS does an annual update, so to speak. It's usually the last week or two of the year, around Christmas, New Year's, where you can't actually really do anything. Well, they started it in mid-November and they're doing it for 2 months and they didn't tell anybody ahead of time. So apparently they need 2 months to do their annual update this year. And part of what you're not allowed to do in that 2-month time frame is e-file your tax return. So anybody that needs their refunds because they're trying to claim their hurricane losses that we're going to talk about, if it wasn't filed pre that, even if you're using TurboTax or something where like it says it's filed, I promise it's just in queue. It's not being processed. So they don't know when they're going to reopen. It's a fun surprise. It's sometime in mid-January. But there's going to be a whole flurry of people ready all these returns that are still down here. So for the rest of the world, that's probably not a big, or the country, that's probably not a big deal. But for us here in Southwest Florida that are still filing lots and lots of tax returns, it's a very big deal. So there's going to be a lot of files in queue. And also keep in mind that if you're planning on waiting until February 1st to call your CPA to do your taxes, your CPA may not be able to do that because we will by then be focusing on our 2022 taxes, which will be in full swing then. So if you're doing them yourself, you know, more power to you. But if you're planning on relying on your tax professional to help you, I know we told all of our clients that hadn't gotten it in yet, December 1st is your cutoff. Get it to us by December 1st because we've got people out for the holidays. We're prepping for season and we don't want to have to rush through your stuff because it was too last minute. So point being is just because you have until February 15th does not necessarily mean you should wait until February 15th.
I have a question. To some of these people when I got Fort Myers Beach where their records were destroyed, what can they do?
So there's a few. So some of it can be retrieved from the IRS. So anything that's a government form, so that's your W-2s, your 1099s, your, you know, if they're retirees, they have a lot of like 1099, like the interest 1099s, dividends, brokerage accounts, stuff like that, student loans, anything that's on a government form can be requested from the IRS. It's called a wage and income transcript. There's a few different types and that's the one they want. And both people need to do it. So if my husband and I both lost our records, I have to get his transcript and my transcript. I can't just do mine and it's all encompassing because it's my social. So that'll get everything that's a government form. Now people who That's not going to cut it. They have rental properties, they have businesses, whatever, but it's not just government forms. The best I can tell you is to go back through your bank statements while it's all still fresh and clean, because a lot of banks only keep it different periods of times. But most of them between the 1 to 2 year mark, they stop letting you access them online, and then you have to actually request your statements from your banker, which of course adds another step on for you. So while they're fresh and still available in your online banking, I would say go in and download, even if you don't look at them yet, go in and download all the statements, and then it's going to be a lot of going through each of those transactions and trying to recreate it. So technically, if you get audited, the IRS does not accept a bank statement as proof. They want to see the physical receipt. They don't want to see the Amazon purchase on your bank statement. They want to see that purchase order through Amazon. I would imagine that in the cases where there's federally declared disaster area, that they would have some leniency on that, because you can't get records that don't exist. Okay, so what is a casualty loss? I don't know if you guys have heard this term floating around or not. I don't think that this is not a new term, but it's new to a lot of us in Southwest Florida. So the IRS definition of what is a casualty loss, which is the loss we're going to talk about you get on your taxes, is a loss can result from the damage, destruction, or loss of your property from any sudden, unexpected, or unusual event, such as a flood, hurricane, tornado, fire, earthquake, or volcanic eruption. A casualty does not include normal wear and tear or progressive deterioration. So that's hurricane. Yeah. Eruptions or anything. Although tornadoes, we did have a client whose building got decimated during a hurricane, one of the tornadoes, but it was still top level hurricane. So how do I write those off? I have losses from the hurricane. I think everybody who talks to you, except for one person that I talked to, has had some form of damages. I couldn't believe that when he had a whole house generator. He's like, yeah, we just so typically, when we don't have a hurricane, this stuff happens. Your house floods or whatever, like, I don't know, your roof, you have a roofing issue and there's just it's summer and your house floods. You still have a casualty loss. Typically it has to be over 10% of your income to write it off. So that means if it's summertime and my roof is leaking and I didn't know that, and I'm out of town and I now have all this damage from it, I still have this loss, but I can't write it off unless it's over 10% of my income. So depending on what my income is, I may or not actually get to take that. So what they do, they actually did it for Irma too. We just didn't see the widespread devastation that we saw this time. So it wasn't as talked about. So what they're doing this time around, if it is a federally declared disaster area, i.e. basically the whole state of Florida, at least Southern Florida, they changed it to you're allowed to take your entire loss, forget the income piece. You just have to reduce it by $500. So I have an example to show the difference here. So example is John Doe lost his roof to Hurricane Ian, as well as most of his pool cage screens and miscellaneous other fencing, soffit, and fascia damages. His total damages after his insurance payout is $15,000. His income for the year is $125K. So over here on the right, we have no Hurricane Ian, right? Just like a normal year, his roof caved in and he was traveling for the summer and didn't know it. By the time he came home, everything was decimated. So it's limited to 10% of his income. So 10% of his $125,000 income is $12,500. So his loss for his taxes is going to be $2,500. So if he's in a 15% tax bracket, that means that, again, no hurricane involved. He only gets $375 of that 12,000 or 15,000 or whatever it was. I'm sorry, that what his damages were. Now, same exact scenario, but now, which is what everybody's going through right now. So they had all of this damage, which is pretty much what we're seeing. He had $15,000 of damage. We don't care anymore about that 10% limit. So now all we have to do is reduce it by $500. So $15,000 in damage minus the 500 floor. They say, hey, the first $500 is on you. So now he's got a $14,500 write off on his taxes instead of $2,500. So now it's going to save him about $2,100 on his taxes for the same loss. So basically what this is trying to illustrate is that they're making it easier for you to write off your losses because so many people were devastated by this, and they want people to be able to not have to get stuck by the normal rules, that you can actually take your losses and get benefit from it. Yes,
Who determines the total
what the loss is.
loss? Is it what's printed on your insurance or what all your receipts have?
So we're going to talk about that. We're going to go, there's a few different ways that can be calculated, and it depends, yep, it's not. So there's a few different ways that you're like allowed, that the IRS says these are the ways you're allowed to calculate your loss. And some of them depend on how much your loss was. So we will go through each of those. And by the way, we're talking about primary residence, right? Mostly today, we're not talking about investment homes. So if you have a rental property, then you're still going to use the same caveats basically to come up with your loss, but it's going to get treated differently on your taxes. Okay, so what can I include and what can I not include in what my loss is? Because there's a lot of confusion with that. I think what you can include is pretty straightforward. Damages to your home, damages to your contents. We had a ton of people who had water in their houses. So literally like everything, they had to throw their stuff away. We had people who had damages to their garage. The water didn't come in their home, but it went in their garage. So they just throw away all of their stuff in their garages. Damages to exterior content. We had a ton of people in North Cape that had water systems that disappeared. Food loss. If you had food in your fridge or your freezer, you are allowed to take that, although I believe it's capped at 500. So even if you just went to the store and stocked up on $2,000 worth of stuff, you're going to be capped at 500. Down trees do count. So I know we had 4 really, really big down trees. So down trees are going to count as well.
That's huge.
And damaged and totaled vehicles, boats, campers, ATVs, golf carts, whatever your toys are that you had outside that got damaged. Again, how we come up with those damages we'll talk about, but all of that stuff counts. So what does not count? Evacuation costs. Everybody's asking us that. Evacuation costs, debris cleanup. So it doesn't matter that you went to Tennessee to ride out the storm and then you Ubered home and it took a lot of money via Uber to get home. None of that's going to count. Maybe for FEMA, I don't know, but not for this is not part of your damages from the storm. Debris cleanup does not cost. Excessive food loss. So again, if you're trying to say I had $1,500 worth of food in my fridge and my freezer that went bad, we're going to cap you at 500. Lost business. Now, you may recoup that on the business side. We're not talking about that today, but that's not part of your hurricane loss. That's not your damages to yourself or your property. And damages to property you do not own. So if I'm renting a house and my landlord basically says, sorry, you deal with it. I'll get to it when I get to it. And in the meantime, we had somebody at my office who was renting in North Cape. Water system blew away and her landlord said, I'll get to it when I get to it. So she didn't have water for like a month, maybe even more than that. Might have been 6 weeks that she had no water. Yeah, exactly. Yes. So even though you may be paying for some of this stuff because your landlord is choosing not to, they're the ones who own the property. They're the ones who have the loss, not you. Now you might have had your stuff damaged. So same case, if she had water come into her house and she had to throw all her furniture and stuff away, like that's hers. She owns all that. She'll have some damage there, or if her car went under, but she won't be able to take, even if she chooses to fix it, she can't take the house damages. Questions on that?
Just a quick question. So it's just the difference between what it actually costs and what the interest,
I can repeat it. She's asking like, so how are we going to calculate what that is? And I believe that's next on my slide. So there's a few different ways we can figure out what that is, but these are the things we're talking about. And these are the things that don't count. So
just example, we have a fence.
Mhm.
We only had $4,000 of the coverage on other structures.
okay.
The fence is $15K.
Okay. So that's going to be treated separately. So I promise when we go through this, that will get answered. And if it doesn't, we'll come back to that. Because we see that a lot with pool cages. So fences we actually just did our fence a year and a half ago. So our fence guy told us, I think when he installed it, that if he attached it to our house, then it would be covered by our insurance, or he could choose not to. So we had him attach it to our house. So ours was covered. But that's the only reason I know about fencing. Yeah. Yes. Right. And then pool cages is the other one where we see a lot that's similar to that, where they're like, well, it wasn't covered under my homeowners. Okay, so how does insurance play into this? Whatever insurance is reimbursing you, you have to back out. So if you total up all of your damages, which I will go through how we do that, but if you total up all of your damages and you say, I had, I don't know, $60,000 in damages with my roof and my fence and my screens and like all this stuff, and your insurance says, okay, we're going to pay, so 60K in damages, and insurance says we're going to pay you 20. So then our loss that we're going to be talking about is going to be 40. If you take the whole 60, you got reimbursed. That means your insurance money becomes taxable because you wrote it off on your taxes. So we don't want that. Insurance money is not taxable as long as you're not writing it off on your taxes. Because if you write, so the situation that's going to be coming up is a lot of like our Sanibel people who are, unfortunately, a lot of them are in the process of suing their insurance companies because they're getting denied. So, well, they have to file their taxes now and they need the relief now. So like a lot of them, because they had such substantial damages, are getting refunds now because of it, and they need the refunds. They can't just wait a year and a half for the lawsuit to come to terms. So in a lot of cases, we're having to estimate out based on what we'll go through, what we think their losses are going to be. And if insurance pays more, then we're going to have to go back and fix it. And they may have to pay back some of that, because if you write it all off and then insurance next year says, oh, yep, here you go, here's all of it, now we have a tax problem.
Sure. We have a question in the chat. So somebody put, so half of the roof from across the street that was in my yard, I can't deduct for the removal. It was half of his roof.
That's debris cleanup, unfortunately. Yeah, I know it sucks.
Since we did the work to make the repairs to our flooded house, can we include the labor charge in those expenses?
You personally did that?
Like they did it themselves, I assume. So if they want to come up with like a reasonable labor rate. So I'm gonna say no with a caveat. I would get estimates or try to see if you have a friend or somebody that you know that would be able to give you something, or if it's too late and you don't know anybody, I mean, then maybe. So in a perfect world, what you would have done is you would have gotten an estimate first, and you would have said, yeah, I don't want to do that. We're able-bodied, we can take care of this ourselves. And then we would have been able to use the estimated amount. So whatever was written on the estimate. Now, if it's too late for that, or if you don't know anybody that can, because obviously they can't see it, the work is done. So if you're not able to do that, then I would say, yeah, see if you can talk to some neighbors or something that had it done, or go online and see what you come up with. Stay on the low side, because again, you didn't get that estimate. So I wouldn't say completely excluded. I would just, I know I kind of sashayed back and forth on that. So, but if you're able to get an estimate from a contractor, that would be great. And if you're not, just stay on the low end of what you think that would cost. Okay. So now we're going to get into the, how do I come up with my number, which is what you were talking about. There's a few different ways that the IRS says that you're allowed to use to figure out what your tax loss is. So we're going to go through each of these. We have the de minimis safe harbor, insurance safe harbor, estimate of repairs, contractor, and disaster loan method. So we'll go into each of those. Some of them are easier than others. De minimis. So this one is a flat $5,000 or less. So these are the people who were fortunate enough to not really have a whole heck of a lot of damage to their homes, cars, stuff, whatever. Where if it was $5,000 or less, the IRS says you don't need anything to support your losses. So you can literally, we're asking our clients to just like write us a list, hey, I lost a bunch of screens, my screen door is down, my gutters are down. Just something, so that if they get audited, we've at least got something to say what it was. I mean, a lot of people still took pictures and whatnot. So as long as it was $5,000 or less, you don't need to do anything. You don't need to get estimates, quotes. You don't even have to do it yet. You don't have to pay for it. It can still be damaged. Our solar panels came down. We're not putting them back up. So it doesn't matter if I never put them back up, because if I was using this, which I'm not, then it would be below the $5 grand. So for example, you're claiming $4,200 in damages to your home. You did not file an insurance claim because it's below your deductible, and you don't have support for them. And maybe you haven't even finished making them, or you're not going to. Under this method, you are allowed to make a list of what the damages are with a reasonable cost to repair and claim that on your taxes. No hard support needed, no repair needed. We saw this a lot with Irma. This was the same rule with Irma, and most people did fall under this back then. So that was the very, very common one back then. Then we have the more common one, which is the insurance safe harbor. This is everybody that's filing insurance claims. So under this method, you use the loss that's reported on your insurance report. If you are using this method, we'll talk that through in a second. Then you back out what you received from insurance, and that's your unreimbursed loss. If insurance says my loss is 50 grand, we're giving you 30. Under this, my unrecovered loss is 20 grand. Your support for this is your findings from your insurance company. Now, what about people who have a fence and the fence is not included in their insurance report, or a screen cage and it's not covered by insurance, so insurance is excluding it from their report? We want to add that on. So it's going to be important to make sure that you're reading through your insurance report to know what's included in it. So, and I believe all the insurance companies are going to do it different. So it's going to be a fun adventure to peruse all of these. But if I have, for example, my home and I don't have pool cage coverage, I do because my husband built pool cages, so he made sure we did. But if I didn't, because most people don't have pool cage coverage, and my pool cage had $10,000 of damage, what I need to do is I need to make sure that that number my insurance company gave me, like my total loss of $50,000, did they include my pool cage in it? And then they just didn't give me any money for it. So does that 50 grand include my pool cage? Does your 50 grand include your fence? And they just didn't pay you for it? Or is that completely excluded from their report altogether because they didn't assess it because it wasn't part of your coverage within them? If it is included in it and you're flipping through your report and you see my fence damage, my pool cage damage, and obviously they just didn't pay me on it, then that loss is a good number, so to speak, because it's included in there. If it's not, if they just completely disregarded it altogether and somebody uses this method and they never read their insurance report to see that, they're going to miss out on it because that would be an additional loss. It was not included in their report. Does that make sense? Did I answer your question?
I think so.
Okay. Estimate of repair is safe harbor. So under this method, you get estimates from contractors support your damages. You do not have to fix it yet. You do not ever have to fix it, but you have to have something concrete to give us to say, here is my estimate from my screen guy, from my roofer. You must, in a perfect world, you are supposed to get 2 estimates, although I don't know how much people are gonna, in the real world, I don't know how much people are gonna, I don't know that they can get 2 screen guys out. I don't know that they can get 2 roofers out, but you're supposed to get 2 estimates. And then your damages, are like the amount that we're talking about, is supposed to be the lesser of the 2. So if you get 2 estimates and one is really low, you might get a third and see where that one, oops, throw that one away. Again, you have to back out your insurance reimbursements to figure out what your total damages are. This is limited to 20,000. So we've got the safe harbor, which is limited to 5 grand. You need nothing. We've got insurance, which is not limited at all. It's just what your insurance report says. And then we've got estimate of repairs, which is limited to 20 grand. Questions on this one?
That's regardless of insurance.
You have to back out your insurance. So we're not relying on an insurance report. So it doesn't necessarily matter what a claim says because it matters what they pay you. So if you say, hey, my damage was 15 grand, I didn't file an insurance claim because my deductible is 12 and I didn't want to get dropped, then you get your whole amount. We just need the estimates for it. But if you did file, if your damage was 18K, insurance gave you $1,500, then we just back that out.
That's just damage to your house, right?
Yeah, house and property. So I guess I should have clarified that. So with your other stuff, so your vehicle, like your drivable stuff, right? Your boats, your campers, your vehicles, all that kind of stuff. De minimis still counts. So you're able to use the 5,001 on that one. And you're allowed to use insurance. Now, what we're seeing with vehicles and the boats and the campers and stuff is most people had an insurance policy where it was either a $500 or $1,000 deductible. And what we're hearing from clients is that their vehicle insurance policies have not been a problem. Most people have gotten paid pretty quickly and pretty easily, and they're saying it seems fair to them. So I see you laughing, so that must not be the case for you. Lucky you. So.
Yesterday, they paid $7,000 to the tow company instead of the collision company, so.
No.
So if you do get shorted, so we still go to actual loss. So like if your car company shorts you $10,000 because that's what they think the value is, my opinion is what we would do is go to KBB, put in your info as close as you can to your car. That's what the IRS uses, by the way. And then back out what they reimbursed you. And then the difference is going to be your loss, but be prepared to have something to support that. So the KBB report would be great. And also, because I'm speaking in a room of real estate agents, if you have a PA or an LLC and your vehicle is titled in that name, that's where the loss is. So what we're talking about, it's not going to count because you probably already wrote off that whole car under your PA or your LLC, which means that we're not going down this rabbit hole, but that means you have no basis. So technically whatever you got from your insurance is all income from a tax standpoint. So if your car is, or I have a realtor on Sanibel who has a really fancy golf cart because all she does is work on Sanibel and it went underwater. So whatever it is that you have, car, boat, golf cart, camper, if it's in your LLCPA name, talk to your CPA. It's not as cut and dry as how much did you get from insurance and what's the replacement cost. Contractor safe harbor. So similar to the last one where you have to get the estimates and whatnot, this one is not limited. There is no limit on this one, but you have to actually do the work or sign a contract to do the work. So like roofers, I know that we have a lot of clients that are roofers. They're not, they're doing lots of work, but like you can't get it done right now. It's not going to be this year, but you're signing the contracts to move forward with them. So insurance will start their process. So you do have to actually have a contract on file that you're going to move forward with them. And then there's no limit, but you have to sign the contract. I'm not a contract attorney. I don't know if you can get out of that contract, but for taxes, you have to have it signed to take that. And the last one is the disaster loan safe harbor. So I think we've only had one client so far that has used this method. They're out on the beach in Naples and had lots of damage. And they did the SBA loan for their homes. So the loan you're allowed to do through the SBA, which is Small Business Association, usually is business loans, but they have extended it to personal for home damages. So when you do that, the SBA does their own appraisal. They send their person out, they appraise it. That's how they come up with how much they're going to give you. So that report is the support for this. So if the SBA, in their case, they said it was, I think, $95,000 in damages, that's what we needed was her report. I think her insurance gave her $1,800. So we backed out the $1,800 insurance. There's her loss. So what about your stuff? Make sure that when you are, whether it's you, your friends, your clients, whatever, when everybody's talking about this, and we'll go through an example in a minute, but you can have multiple losses. So I may have my loss because more so it's the people who went underwater. So if my father-in-law, his house went underwater. He had a boat parked in the driveway. So he probably had a boat loss. He had all of his stuff in the house. So he would have had his stuff loss. And then if he owned it, he's renting, but if he owned it, then he would have the actual damage to the house. So there's 3 different losses in this case. And if his car was there, he'd have a 4th one. He'd have his car. Each thing in and of itself is separate. You may use different methods for different things. You may say, I'm going to use my insurance report for my house. I'm going to use the de minimis for my stuff. And I'm going to use something else, contractor. I guess for your boat, it would be insurance, but like you can pick and choose which one you have the support for depending on your damages for them. It is not one size fits all. If I use de minimis for this, I have to use it for everything. So your stuff is a little bit more complicated. Excuse me. It also has the $5,000 de minimis. So again, this is mostly our people where they had water in their house, where they lost all their stuff. You can do replacement cost for your stuff. If you choose to do that, you have to make an itemized list of all of your stuff. So if you had water in your house and you had to throw everything away, that's a big list. And you have to write down each item, how many years you have owned it, and what you purchased it for. So my advice to people is do the big stuff, because you probably know, like my dining room table, I bought it 3 years ago for $1,000. You probably don't know when you bought your towels and your rugs and stuff like that, but you probably know. So write down the big stuff and then kind of just do general kitchenware, general bathroom wear, and do the best you can. The reason the year is important is because it has to be, depreciated basically, like wear and tear. So if you bought $1,000 couch 4 years ago, you don't get to write off $1,000 loss because you've had it for 4 years. It has to be written down, which hopefully your CPA will do for you, but you have to make the list. Then once we do that, right, you give us this list and you say, I had $30,000 worth of stuff, and we like write it all down based off of how long you've owned it. Now the difference between that, which is your loss, and what the current value to buy it is, that's your loss. So I think we've only had one person do that. Everybody else says, I'll just take the 5,000. I didn't have anything of value. My furniture wasn't super expensive. I'll just take the $5,000 on that. And that sounds like a lot of work that I don't want to do. So we actually just spoke about that yesterday for a client. So it's a lot of work. So I have an example, and I think this is pretty much the end. So then we'll go through questions and some case-by-case stuff. So example, Downer Debbie had $65,000 in damage. I know I like to do fun names if you haven't noticed. Had $65,000 in damages to her home. This is pretty common, by the way. This is why I'm using this as an example. She filed an insurance claim and they're reimbursing her $55,000 after her $10,000 deductible. She also lost $6,000 in her stuff because water came into her garage. She does not have contents insurance and will not receive any money for this. Her vehicle also went underwater, and her deductible on her vehicle was $1,000. So in her case, she's got 3 different losses. She's got the house damage because she owns her house, her stuff that all had to go to the road and may still be at the road, and her vehicle that went underwater. So for her home, she's going to use the insurance method because she's not fighting insurance. She thinks it's fine. So she's going to take the $10,000 that insurance is not reimbursing her, 65 less the 55, 10,000 is her out of pocket, and her support is going to be her insurance report. Now, in our case, we have a roofer coming out right now that is telling us whether they think insurance is right or not. So like, even though I have an insurance report, if my roofer comes back and he gives me a report that's different, then I'm not going to use insurance. I'm going to look at my roofer's report and see how it all lines up. Her second loss is her stuff. Yes, it was $6,000 in stuff. She's going to take the $5,000 de minimis because she doesn't want to make her list. By the time we write down her $6,000 worth of stuff, it's probably going to be less than that anyways, and a whole lot of headaches. And she probably won't ever get around to actually doing it. So it'll just sit there on her to-do list forever. So she's going to take the $5,000. And her third, which is her vehicle, she had $1,000 deductible on her vehicle. She's not arguing it, and she thought the replacement was fair, so she's going to take her $1,000 bucks. So her loss on her taxes is $16,000. $10,000 from the house, $5,000 for her stuff, and $1,000 for her vehicle. Questions on any of that?
If you have insurance on belongings.
Yes.
Content,
Yep.
the difference then becomes, I mean, because I had to make that stupid list.
Yep. Yep. You think about it so fondly, huh?
Yeah. So then the difference becomes what they paid us.
Correct. So it would be $6,000 less if she had $2,500 of her deductible for contents. It would be $6,000 minus her deductible for that.
So my list was 30-some thousand in loss.
Of
and they
belongings.
paid us 18.
So the difference there is going to be what your loss is. Yes.
Question from the chat is, so the $5,000 that you're talking about, that only applies to the stuff. It wouldn't apply to everything overall.
It's each loss. So she could have taken, if she only had $3,000 of loss for her house, like after insurance paid her, say it wasn't 10 out of pocket, it was 3. She could take well, you're supposed to take 5 if you actually have 5. But so say she had 5 out of pocket. She could take the 5 here. She could take the de minimis 5 for the damage to her house. And then this is the next loss. So she has another 5 that could be if she's using that method here. It wouldn't be for her vehicle, but let's say, for example, so like we have a detached garage that we built that is covered by our insurance, but we just added it on to insurance like 6 months ago. So like if we hadn't done that yet, and then let's say that the roof came off of our detached garage, that's not going to be covered by my insurance report. So I'm going to list that as in this case, it would be a 4th loss. And I'm going to call it, same thing with pool cages, a specialty structure. And I would have another 5 for that. So it's not an overall 5, it's per loss. But you can't use that for vehicles. There's different methods. So you can use it for your properties, your house, your pool cages, your specialty structures. We see like barns and stuff like that. Some people have, and you can use it for your belongings.
Okay, last question on the chat. So, you're using, for this example, the support is the insurance report, but you're saying you can also use an SBA loan estimate as your support.
If you're using that method, so you're going to pick which method, or your CPA is going to pick which method. So yep, you can absolutely use the SBA loan as your support. And they break it out for contents. We had one person so far has given us that, and it did break it out really nicely that the loss was this much. This is for your home. This is for your contents, because we want to give you the maximum benefit on your taxes. We don't want to lump it all together.
I was on for 2 weeks, so forgive me.
Okay.
But because you have all of these different choices and avenues for saving money and so forth, what do you say to the people who are offered a check from their insurance company? Does that affect any of that kind of stuff? And they're like,
Well,
take the money and.
it doesn't affect it from tax. I mean, I guess it could. It's more so on, because we have to back out what you get reimbursed for by insurance, right? So if we have a $50,000 loss, insurance gives you 30, you got a $20,000 loss. That's what you write off on your taxes. Now, what's important, which is not on the tax side, I mean, yes, it all plays into it, is if insurance is shorting you, you would rather get the money from your insurance than the tax write-off. So if you're concerned about, and now what we did, I asked my roofer and he said, because we got a check from our insurance, and then we had the roofer come out and he said, you can deposit your checks. That's not me saying it. It's a random, not random, but I'm not gonna say his name. It's a local roofer. And it won't affect it. So like if you deposit your check, you can still challenge like it doesn't mean I'm accepting it. He would say it would be treated as like a down payment if they gave me additional monies. But whatever you get from insurance is going to affect your loss. But ultimately, you want insurance to pay what they're supposed to pay first and foremost. Whatever they're not covering, then we go, okay, how can we save you some taxes on your out of pocket? Okay. So when do I claim my losses? So this is something a lot of people don't know. And then I think this is my last slide. Yes. So everybody thinks they have to do it in 2022. Or 2023. And the answer is actually that you can, of course, claim your losses in 2022, but you are also allowed to amend 2021 and claim your losses there. And you cannot do it on 2023. So for people who are self-preparing their taxes and they don't put them on 2022 because they're still dealing with insurance and they don't know what their loss is yet, and they go, oh, I'll deal with it when I get paid in 2023. Can't take it in 2023. The hurricane happened in 2022. I actually had a call with a client yesterday and I told him, I said, you can take it in 2021 or 2022. And he goes, oh, you mean 2022 or 2023? And I said, no, I mean what I said, 2021 or 2022. So the reason they allow you to go back to 2021 is because you can get relief now. You don't have to wait. A lot of people, if they don't file until June of 2023 for their 2022 taxes, they won't get the benefit till then. But if you amend to 2021 now, then you can, and you've already paid everything in, or you haven't filed yet, you can get some of that money back that you've already paid in by claiming your losses. Now, in some cases, it's going to depend on you. And it depends on how much loss you had, because there are some people who had a really big sway in their income. So especially in a real estate world where it does go up and down depending on you and how active you are in the markets and stuff like that, is if 2021 was a really good year and 2022 wasn't as good of a year, it might make sense to go back and pay for someone to amend, like your loss isn't changing. If you've got a $50,000 loss, you've got a $50,000 loss. You may get more bang for your buck if you do it on 2021 because you were in a higher tax bracket than in 2022, or vice versa. If you know that you had something happen this year, you sold an investment property and you're making a bunch of money off of it and it's a one-time thing, you want to take the loss, unless you need the money right now, you want to take the loss in the year you're going to get the most bang for your buck. But that also means that if you don't yet know, so come tax time for 2022, so during 2023, if you're still dueling with insurance, which a lot of people who had big devastation are going to be, they're going to have to just do their best guess and file a return. And then when it all shakes out with insurance, probably have to amend it later. because they're just not going to know. So a lot of like our Sanibel people were going through and saying, all right, well, what's your deductible on your house? $30,000. Okay, well, we know they're not going to cover more than your deductible, so we can give you that. You didn't have pool cage coverage. We know that's going to be an add-on, so we can take that. You lost all your stuff, so we can kind of work through an estimate and get them some benefit now. And then if insurance comes back and says we're not doing any of it, then we can amend it and give them the rest of it. Okay, any questions?
It says, so we could take up to $5,000 for the flood damage to the house, i.e. baseboards, drywall, doors, etc. And then another $5,000 for stuff, such as furniture, appliances, computers, stuff.
Correct. Yes, easy answer.
Andrea, where does this hit on the return? Is this like income and then losses, or how is that?
It's going to be within your, like, if you're looking for it on the tax return, it's going to be within Schedule A, which is for itemized deductions. So even if you don't typically itemize, it doesn't matter. There isn't like the normal rules for that won't apply. It'll just go on top of it. So if you take the standard deduction, it'll just tack it right on top of that. It will probably then force print, depending on the provider being used, that Schedule A. So like typically, if you take the standard deduction, you don't see a Schedule A, but doing this in our software, it forces it to print and then you see it and it says casualty loss. Then there will also be an attachment. I think it's a 4868. 4684, and it'll say on the top casualty and theft losses, and that'll have all of the details. So that's where it'll actually list out my personal residence and the method that you claim. Does the method go in there?
I think it's one line item.
Yeah.
It's like columns.
And it'll say, here's my losses. And then, you'll list out each of the things that we're talking about, your stuff, your house, your car, all of that. So there's a few different places it'll come through, but ultimately the actual loss will go on top of the standard deduction or on top of your itemized.
If you're giving me heart palpitations.
No, I'm. leaving it.
Here, have a mint. This would be a great year to have somebody help you, by the way.
Well, that's my question or questions is that this sounds very complicated when you don't know what you're doing in the first place with taxes. So
Yeah.
what kind of, this sounds very complicated for you to go through some of these,
Yeah.
things, like, if we do this, it might look like this, and if that's work.
Right.
Work is
It
time,
is,
and it costs money to do that.
Mhm.
What does that look like for you guys to do tax returns for people this year? And what does that mean if they have corporate accounts and they have personal account? I mean, did they get a discount? What does that look like for you guys?
So everything that we talked about today, again, is going to be on the personal level. So we did not go into, because once the business gets involved, we have gains, like it gets more messy. So we're just talking about primary residence, cars and stuff you own personally, and your personal stuff. So we will be doing an add-on for all of our returns. There's an additional fee for us to do this because it's taking a few hours for us to do it. But we should be making sure you get the right amount of money back, that you don't just give us your insurance report and we're like, all right, cool. And nobody ever asked you the question and you didn't know that, what about my car? What about my stuff? A lot of people don't know, well, hey, maybe you shouldn't take it this year. You should have taken it last year. So there is additional fees for it. I can't give an exact amount because it's going to depend on a lot of things. It depends on what people give us, what kind of support they give us. If I get a box of receipts, we're probably going to call you and say, right. But we would love to talk through, right. We would love to talk through anyone who has questions about that. And then we can give them a proposal for them.
There's an add-on. Makes
Yeah.
sense. Sounds like work.
And
Yeah.
that's really why they should hire real estate agents, right? Because of all that little extra work and the things that we have to do to help save the money.
It costs money.
Exactly.
So, yes, that's why professionals hang out together.
Absolutely.
And so I know you got tons of questions, and probably the best thing to do would be to call or email her, instead of just even maybe just an appointment to just chat about your
Yeah.
situation.
Yep.
And then kind of go from there. I mean, I've learned like a gazillion things like today. I mean, everybody thinks all they're gonna get is like FEMA.
Yep.
They're gonna get this, and this may provide a lot of relief for people where they may be able to stay in their houses a little bit longer. And then ride through the storm and then be able to sell it later, or they may be able to find a benefit of getting rid of their house. now.
We also have
Moving
a,
forward.
we have a bunch of YouTube videos that we were fortunate enough, my office got power back. Maybe you guys did too. We're not far. The Sunday after the storm, when a lot of places still didn't. My house did not. None of my employees did, but my office did. So we were doing a bunch of YouTube as this stuff was coming out, like diving into some of it. And there's a bunch of them on the loans as well. So if anybody has any questions and
aren't sure about calling yet, they can certainly go find us on Facebook, find us on YouTube, and they'll see some resources
Done
there.
Forbearance and all that kind of stuff. That's all gonna play into their taxes now, yeah.
I don't think I did any on that, but like
Okay.
a lot of them are on, it's on this stuff, the details, how do I, like pretty much what we spoke about today. And then there's a few that are on the SBA loans and what the details are on those and does it make sense for someone on our Facebook or on our YouTube.
Which is. You
Noack
look up-
Company.
Noack Company, yes. I don't know the official handle, I guess, but yes, if you go to Noack Company CPAs, you'll find on our Facebook and our website, we'll have it, of course. So I'm sure they have the little links on all of it. So-
And congratulations on buying out the company and.
Thank
we're
you.
Proud owner
Yes, thank you.
of a woman-owned business. I know John's behind you, is right?
John is next to me, not behind me.
All right, so that's that for today. Again, get in touch with them, and if you've got any questions, really do that, call us.
Mhm.
We will edit this out. We will send out the link to those people in the office who were too busy today, hopefully with customers and not your appointments. Getting it done. And as we always say at the very end of all of our text and training, peace out.
Thank you.